We're looking at this bull market that is 2 years old, so entering its third year. Bespoke out with the fun chart today, looking at other bull markets that reached 503 trading days and how they
Sure.
did. And we're at about average in terms of how much we're up. We're up
Average,
about
absolutely.
63%.
Right.
So now as we go into the third year of the bull market, if we've already priced in all that good news, what's going to be the thing that continues to push the market higher?
I'm quite sure it'll be earnings. I hope it's not valuation multiples because, as I said, they're already stretched. They're kind of getting close to where they were back in 1999. The forward PE is at 22. It got to a peak of 25 back then. The Buffett ratio, which is the S&P 500 price index to revenues, is at 2.8. And back then it got up to, I think, 2.2. So we're at a record high on the Buffett ratio. Buffett always said that, when that ratio gets to 2, he's a seller. And that's apparently what he's doing. He's following his rule of thumb. So the valuations are stretched. I don't want to see them going higher because then we got a 1990 melt up scenario, and that's fine. You can make a lot of money still from here, but then you got to figure out when to get out, and then you have to get out pretty significantly. I'm thinking that the market goes up on earnings, and that earnings, which were probably about $250 a share this year, go up to $275 a share next year and $300 a share the year after that. By the way, by the end of the decade, I think we could be at $400 per share, which times a 20 multiple or so gets us to 8,000 on the S&P 500. So I think it's still a bull market. And like you said, it's kind of a middle of the pack bull market so far, and it still could go a while longer. It could go through the end of the decade.
So given, Ed, kind of your views here of the economy, earnings, what would you be avoiding? Would it be defensives, staples, cash?
Well, we turned bullish in late October of 2022, so we've been bullish for a while, and we were recommending overweighting technology and communication services. That's worked. We've been recommending overweighting industrials. That's worked, and financials. That's worked. Not energy. Energy we thought would be a good a shock absorber in the event of geopolitical risk. So 3 out of 4 ain't bad, but we're still there. We're still overweighting technology, financials, and industrials. Don't mind really having some consumer names since we think the consumers are still in pretty good shape, but not too keen on utilities, not too keen on interest rate sensitives because we don't think interest rates are going to come down as much as the market has been discounting. Same thing happened at the beginning of the year. The market was expecting 6 to 7 25 basis point rate cuts. We were expecting 2 at most, maybe 3, but we didn't jump in with the market thinking the Fed was going to have to lower interest rates a lot.
Well, Ed, sort of on that point as well, with the 10-year Treasury above 4% and seeming like it's going to stay there for a little bit, one of the areas that in the past that had been problematic for was technology. Is it still problematic for technology? Is that a concern of yours at all?
Not really. I mean, to me, 4% is normal. This is all about normalization, in my opinion. I know a lot of people logically thought that with the Fed funds rate going from 0 to 5.25% in less than 2 years, that inevitably would cause a recession. We were not in that camp. We were in the no landing camp since 2022, since the Fed started raising interest rates. And our view was that 4%, 4.5% is kind of where we were before the great financial crisis. We're finally normalizing. The real abnormality was zero interest rates, quantitative easing between the great financial crisis and the great virus crisis. So the economy has demonstrated that it's resilient and it could certainly deal with 4% bond yields.
Ed, good to see you. Thanks a lot. Appreciate it.
My pleasure.